Hello and welcome all to the Paris Finance Forum and to this session focused on which financial market architecture for an integrated Europe. I'm Angela Barnes, Euronews' business editor, and it's a pleasure to be with these excellent panelists today to discuss this. So first of all, we're going to talk about the Capital Markets Union. Now, over the last 10 years, on the outside looking in, it appears that little progress has been made. So Hugo Bassi, first of all, let me introduce our panelists. First of all, we have Hugo Bassi, Director for Financial Markets at the European Commission. I'll come to you first for this question, but thank you very much for joining us. As well, we have here Stéphane BOUJNAH, the Chief Executive Officer of Euronext Group. We have Verena Ross, Chair of the European Securities and Markets Authority, ESMA, and we have James von Moltke, President and Chief Financial Officer at Deutsche Bank. So thank you very much to our panelists for joining us. So as I said, let's go to the Capital Markets Union. Hugo, so it's been an interesting couple of days. And political will, of course, we've seen over the last 10 years has perhaps not been behind the Capital Markets Union. So can you just set the context for us? And of course it's complex, but how in your view is it going now?
Thank you, Angela, for the question. And thank you for having me here. First of all, good morning, everyone. First of all, I would say that a lot has been done already. We should not totally underestimate what has been done in the last 10 years or so of Capital Markets Union. It was clear from the beginning that the project was complex, difficult, and also the decision was deliberately taken to launch a project which was with a sort of piecemeal approach. So it was decided to identify the market failures and to address them one by one. And I have to say that the two action plans, the first one of 2015, I think, and the second one, 2019 or so, have been fully delivered by the Commission, for sure, and I have to say with a different pace also by the legislator. So we have more than 35 initiatives which have been transformed into law, which have been adopted. Now, first of all, is this, can we already see the results of that? For sure, not yet. First of all, it's a question of time. This measures will take time to produce results, and certainly we are not able to see them yet. Secondly, and probably more importantly, I'm not going to hide myself behind my finger, is that enough? For sure not. It is not enough, because what we need to do today is to scale up the project and hurry up, because we have no more time. I mean, the slogan is no longer a nice to have, but a need to have. If we want as Europe to remain competitive, and if we want to not to run the risk of becoming irrelevant on the global scene, we need to progress in that space and quickly. Now, you mentioned political will. This is the issue, in my view. One of the reasons why we didn't go as far as we at the Commission would have wanted is because not always, and not all the member states have shown a degree of political will which is necessary in order to progress. And therefore we are at the Commission, and of course I cannot speak on behalf of the new Commission or Commissioner who will start only later on this year, but we, at technical level of the Commission, we firmly believe, and we are following the debate which is taking place within the Eurogroup, the European Council, and we are and different proposals like the Noyer report, the Letter report. We are waiting and looking forward to the Draghi report as well. We see that there is a lot of ambition, at least in terms of intentions. We hope that this will transform into concrete actions. I'm sure that we will talk about the content of the proposals later, but that's what we expect, a scaling up of the project, because we all need it.
Hugo, thank you very much, and for setting the context for us and where we are now. And Stéphane, if I can move over to you next, please, on this. Talking about political will, but there's also the question of financial literacy and educating as well and informing more investors and the public about the Capital Markets Union. Stéphane, what will the benefit of the Capital Markets Union be for European companies, and do you think enough effort has been made to educate the public and investors about it?
I'd like to connect your question with the previous one. I think the game changer is precisely the political leadership which is in the making for what is being rebranded from Capital Market Union towards the European Union for savings and investments. There is a lot of fatigue and frustration about the Capital Market Union because we can't even remember when we were young and slim and when we started to make panels about Capital Market Union 10 years ago. And everyone has to understand that the Capital Market Union was a concept invented by the Brits when London was the largest financial center of the European Union, and when they tried to cement that role, and there was a consistent continuum between London within the EU, Jonathan Hill, Commissioner for Financial Markets, Capital Market Union. There was a sort of harmony behind that. Then the UK left the European Union. They left on the table the Capital Market Union. London is not anymore the largest financial center of the European Union. It's the largest financial center of the United Kingdom. So we were left with the Capital Market Union. Those guys at the Commission did what any smart assembly of bureaucrats should do. They continued to process the project, but without any very strong political leadership. And they produced what is, for many of us, a sort of fragmented menu of baroque measures without strong, consistent vision. That's why we have very ups and downs and very curious things, like, for example, the decisions on unbundling equity research, where after a couple of years of execution, everyone says, oops, it doesn't work, or the idea of bring back lit markets from systematic internalizers to bringing more volumes to lit markets, and everyone say, oops, it doesn't work. So, I mean, it lacked prioritization. The good news is that because of a number of reasons, in particular related to the IRA, related to the magnitude of the money we need to raise long-term and risky for climate change financing, the money we need to raise long-term and risky for digital transition, the money that we need to raise long-term and risky for defense expenditures or defense industry strengthening, we are in a situation where we must accelerate some form of redirecting of European savings towards European equity. And that's good news, and there is now a political ownership, so I'm very confident that things are going to accelerate big times. The fact that Leta highlighted that financial markets have to be part of the single markets and not excluded from the single markets as they have been excluded in the 90s. The fact that Christian Noyer made clear that we need to end the anomaly, the paradox of Europe exporting savings and importing equity. The fact that we are now in a situation where Draghi will propose very ambitious measures in his competitiveness report. So it makes me extremely, extremely positive about the fact that Europeans are going to start, at least European leaders are going to take ownership of that ambition. The good news is that they will have a refocusing on things that do matter. We will break taboos that were existing in the past, like single supervision, like all sorts of things that have been delayed forever. And I think, which is the most important point, there is an increasing awareness about the fact that it's useless to have a strong and ambitious European Union for savings and investments if there is no, in parallel, a complementary set of measures at the level of the member states to unleash liquidity and to kill the incentives that we have today in all our respective member states that drive savings towards A, debt and public debt, and B, to export towards outside the EU. So we have incentives that need to be killed to make sure that equity, that savings is driven towards own funds of European companies. And that means that the regime of l'assurance vie in France is becoming an anomaly at the time of the Capital Market Union or the Union for Savings and Investments. It means that the regime of that subsidize capital gains on govies in certain countries like Italy is going to become an anomaly anytime soon. And it means that if we want to have a proper Capital Market Union, there are only three rules. The first rule is liquidity, the second one is liquidity, and the third one is liquidity. And the only way to get liquidity to European markets is to kill those incentives that go to private debt rather than equity.
Okay, well, Stéphane, thank you very much. And we are going to go into more detail on supervision and pan-European savings and investments products as well. But let's just go over to Verena Ross from ESMA to get your view on this, because ESMA recently released a paper with 20 recommendations for a more effective capital markets in the EU. So, Verena, key recommendations, they included developing a conductive ecosystem for public companies and fostering pan-European markets while addressing barriers to integration, particularly for market infrastructure. So what do you think is needed to make this a reality?
Thank you very much. And first of all, I'm very pleased to be here today. Thank you for the invitation. And indeed, so we published this position paper a couple of weeks ago, really trying to contribute from the securities markets regulator and supervisory perspective to the debate on how do we take capital markets forward in the European Union and what can we do better and where do we really need to focus. And one of the areas, as you rightly say, is the whole area of how can we boost the funding and capital available to EU companies. At the moment, a lot of our companies, as we know, make the choice based on good analysis and looking at the pros and cons of not actually listing in European markets. And that is something which we need to clearly address. And I think there's really three areas that I would emphasize here. One is the point of which Stéphane already mentioned, how can we increase the equity culture in the European Union? How can we make sure that companies actually feel that they see equity raising as one of the areas that they could pursue to get funding? And as part of that, we must clearly create the right incentives. We must also have the right capital market ecosystem that supports these companies to actually make those choices. And we need to also ensure that the regulatory obligation on listed companies are really well tailored and we are not disadvantaging them vis-à-vis unlisted companies unless there's a very good reason for investor protection to do so. I think secondly, it is about building scale, and that is making sure that we actually bring the capital markets in Europe together to ensure that we have better cross-border liquidity. And at the moment, we still have very often 27 individual markets. We have barriers between those markets, and it means that the liquidity doesn't flow freely from one place to the other. And that means that there's no scaling. It means that there's still the little pockets in different parts of the market. And we really need to start bringing that together by promoting pan-European segments, by making sure that the barriers to further integration are broken down. And I'm sure Stéphane has much to say about that, trying to practice that on the ground. So I think finally I would say there's also the point that it's not just about financial regulation, and Ugo already said, in a way, we've tried already in a number of areas to try to break down some of the barriers because we have still individual company laws, individual securities laws. All of that is not easy to shift, but looking at where it would really make a difference to reduce the barriers that are currently holding us back from bringing these liquidity pools together and actually creating a genuine single European market.
Thank you very much, Verena. And if we can go over to James on this now as well. And Verena, as you were saying there, that companies are opting to delist in Europe and turn their heads over to the US, of course, that deeper capital pool. But James, in your view, what impact has London, the loss of London, had on the Capital Markets Union project? How has that changed the calculus, and has the project got harder?
Well, I'm going to, first of all, thank you for the invitation to Paris Europlus. I'm here more as a representative of the European Banking Federation. So the initial invitation was to my partner, Christian Sewing, the president of that. He needed to be in Berlin, but thank you for the invitation. Look, I'm going to disagree with Stéphane. I think London remains enormously important to the capital markets in Europe. And in essence, we're in this odd situation that a lot of the decision-making for Europe, a lot of the capital formation still runs through London. If you're taking it from a European perspective, therefore, there's an urgency and an importance if you take it, if you want autonomy, if you want to mobilize the savings of the European economies to fund the European economy. And therefore, everything that's been discussed so far on the panel makes perfect sense. Removing frictions, bringing the markets of Europe together so that you can concentrate liquidity, simplify things like listing rules and market access, as well as the centralization of counterparties clearing and what have you. Those are all sensible things. To your point, Angela, I think that Brexit makes it more urgent to bring these things into Europe and reestablish autonomy. And we all know the statistics about the percentage of the European sort of economic activity that's still financed by the banks. With capital requirements for the banks going up, that financing becomes more expensive to provide. And Europe is characterized still by a high proportion of savings in deposits rather than in risk assets, whether equity or in fact other fixed income assets. So there's a lot that we can do here, but I think the urgency has only increased as a consequence of Brexit.
James, thank you very much. And there is so much more talking to do on Capital Markets Union, but we have a lot to get through in 30 minutes. So we have to move on now to supervision. And if I can start with you, Stéphane, on this subsection, can I ask you, why is unique supervision important for Euronext to start with?
For two reasons. Rules, and the first reason is about the lack of a single rule book, of single rules across Europe. We have rules that are gold-plated locally through transposition, integration in local regulation. And you know, when rules are similar, rules are different. And we are, in reality, in a situation where integration of capital markets, integration of flows of capital require absolutely identical rules. That's the starting point. But even when you have identical rules, when you have different market supervisions, you have different interpretations. So you pile up divergence. You have a directive, then you have transposition and gold plating. And gold plating, by the way, is unavoidable. Gold plating is part of parliamentary democracy. You have a scandal in country A. Parliament gathers and say, well, we have to change things. The only subject matter that is available is a piece of European regulation transposed in local regulations. They gold plate it. So unless you have a single rule, like the euro currency, you will not have, you will not eliminate divergence. Second, different interpretation. You have in Europe 27 market authorities that are fundamentally different. You have some countries where in reality the size of the capital market is limited, and when you have leaders of market supervision authorities that are not very much aware of certain products. You have other countries that are extremely that have an extreme large financial market, with very supervisors that consider that their role is just to, strictly speaking, interpret and apply the supervision. You have other countries who consider that the Market Supervision Authority is in fact a sort of ministry of capital market that needs to steer, develop, and have an opinion on everything that can contribute to the growth of capital market. You have a totally different approach of what regulation and supervision means. The only way, if you want to integrate some platforms like us or other platforms that are headquartered in one single country but that operate in various countries, is to have one single supervision, like we have the European Central Bank. Like ESMA, but not ESMA of today. We cannot continue with the board of 27 people having a decision. We need to fundamentally change the governance of ESMA and make it closer to the ECB, where people who have skin in the game and who are more competent than representing their own flag are around the table. We need to federalize the supervision of capital markets to have a proper European SEC. The good news is that the Commission has done the whole thing bottom-up with the invention of the single prospectus in the Listing Act, because we'll have pretty soon a European S1, to speak in equity capital market terms. But we need to have, just like we had the ECB after the financial crisis as an enabler for the banking supervision, the ECB for the euro and the single supervision mechanism after the financial crisis, we need to go to process away. I believe that we can do it because it was a taboo. There is some resistance here and there, but unless we do that, we will not unleash the potential of the savings and the investment union.
Okay, Hugo, I can see you're very keen to chip in there. Are you in agreement as well with Stéphane? Is the EU-wide supervision, will it ever happen?
No, I mean, I'm no, in the sense, it's not the answer. I hope so. I mean, if you ask me, I'm convinced, of course, that centralized supervision, at least in some areas, is more than necessary, is a must. On the other hand, as Stéphane remembered, we've tried already to increase the areas where centralized supervision is active in Europe, and we had to face, again, serious problems with this political will we were talking about before. Now, it is true that the debate, as I was saying, we're very happy to see that on the table of the Eurogroup and the European Council, the issue is back. If this will transform into concrete action still remains to be seen. In terms of possible solutions, we have an enormous spectrum from a little bit more peer reviews until the European SEC. So, and we have a lot in the middle. Probably, if I had to bet, I will say that in the end, the cursor will put somewhere in the middle. Probably we will identify some areas where central supervision will be achieved. I am a little bit more skeptical to believe that we will have a single supervisor as we have SSM in the area of banking. In the banking union project, it was decided to start from the institutions. The approach that was taken in the area of capital markets union makes it a little bit more difficult, and for a variety of reasons that I don't have time to touch upon, it's a little bit different.
If I may, obviously, the analogy with the European Central Bank and the single supervision mechanism is for the sake of the argument. Nobody here is suggesting that what is the specificity of a capital market supervisor, i.e. the supervision of both infrastructure and market participants, but also issuers, is going to be under the same roof. Clearly, issuers, compliance by issuers of stock exchange regulation and corporate law will have to remain local. But when it comes to market infrastructures, when it comes to post-trade infrastructure, when it comes to all the large asset managers that operate in multi-jurisdictions, there must be a single way of interpreting single rules. And that will require moving the cursor closer to the European SEC than to improve peers review. Okay,
Stéphane, thank you very much. If I can go over to you next, James. I just want to point to the Noyer report as well that recommended the integrated supervision of capital market activities, reforming the governance of ESMA and extending its supervisory powers as well. James, what extent do you think the approach could alleviate obstacles from what has been tried in the past that would allow this to work?
Well, look, we would endorse the recommendation. I mean, it's rare that a supervised entity or regulated entity would sit next to their regulator and say that that regulator should get a lot more power. But honestly, we believe that, and I think Stéphane put it very well. You know, again, capital formation, mobilizing savings is only going to happen if we can create a more harmonized regulatory environment in Europe. You have to remember as well, I mean, we think of the SEC as somehow a unitary regulator in the United States. It's not. There are state regulators in the United States. They have certain powers, but they tend to follow a uniform code and act. And there's no reason we can't imitate that in Europe. And you have to again, to Stéphane's point, you have to look at what should reasonably be in the power of any individual domestic regulator that isn't already covered by European-level regulation, whether it's investor protection, whether it's supervision of listed companies. But I think the idea of a great deal more centralization with a change in governance of ESMA, powers, the ability to issue no-action letters, and potentially a mirroring of the JST to us would be a very powerful sort of driver to unification of European capital markets.
Brilliant, thank you, James. Now, Verena, clearly ESMA has support there for more supervision powers. But what, in your view, would supervisory consistency at an EU level look like at its best?
So first of all, I want to thank all the other panelists for fully supporting more central supervision. Obviously, I fully agree with that. I think I would, however, want to briefly start maybe with Stéphane's first point, because I think we also need to look at the regulation in Europe. If we really want to talk about strengthening capital markets, we need to talk about supervision, but we also need to talk about regulation, because the reality is that we still have a lot of the legislation that is actually not uniform. And it's also something where the regulatory framework remains maybe reasonably well placed for what it used to try to regulate in the past, but the markets are changing quickly. We need to have a far more agile way of being able to also change regulation and adapt them to market developments. So I think there's a real need to also look at how the overall regulatory framework works. Do we need more agile instruments as supervisors and regulators in Europe to be able to replicate, for example, the no-action letters that our colleagues in the US or UK, for example, can use to try to adapt to market developments in a rapid way. So that's just one point on regulation. Moving to supervision, obviously ESMA since 2011 has taken on gradually specific direct supervisory mandates. I think we've shown that we can actually execute those and that we are a credible supervisor at European level. Having said that, and many others have said it here on the panel, it's clear that a lot of the financial entities in Europe will remain supervised at national level. When it comes to investor protection, when it comes to locally operating firms, clearly the local supervisors are the best place to deal with that. And that is something where ESMA will continue to work to try to drive further convergence of the supervisory practices, of the supervisory approach. It's not easy. Stéphane explained it very well. It's an uphill struggle, but we will certainly continue to do that because we believe even for whatever part of the capital markets, the fact that we actually have the same or very similar interpretation of how the rules should be interpreted and supervised is important. Now, finally, to central and direct supervision, I think certainly, and even I have to say, you talk a lot about governance, but the ESMA board of the 27 national supervisors sitting around my board have agreed in our position paper exactly to the point of saying we need to look at this again in specific areas. And for example, for pan-European market infrastructure, post-trade exchanges, it makes a lot of sense to investigate whether you can't have more efficient supervisory systems if you start looking at centralization. And that is because it's genuinely pan-European. You risk otherwise regulatory arbitrage that does not help, but actually hinder the capital markets for Europe. And thirdly, it can also create efficiencies. And we need to look at those type of criteria and really look at where does it therefore make sense to move from a national supervisory system to a genuine European single supervisor. And as I said, market infrastructure, pan-European is clearly one example. Another example which we cited was crypto asset service providers. Very new part of the system, but now being implemented 27 times. So each supervisor needs to build up the capacity, needs to build up the knowledge, have the people in place, and actually then decide how to regulate these entities. That's just not very efficient.
Task at hand, Hugo.
Just one word, because what Verena is saying shows that we can be optimistic precisely because you know, one of the areas that we have negotiated very hard in terms of powers of ESMA very recently has been the area of post-trade, clearing, in EMIR 3.0. We've tried as much as possible to entrust ESMA with more centralized powers, and it was impossible to go further than what we have achieved. Now, if we hear, and we hear, that things are likely to move, and a few months later, maybe we can be a little bit more optimistic. But, you know, it's a little bit of a paradox that this opening that we hear from many member states on centralized supervision in the area of clearing comes 6 months after the conclusion of the negotiation of EMIR 3.0, where we could not achieve it.
Okay, Hugo, thank you very much. Cautious optimism. Pan-European investment products, let's move on to that. So another way of achieving an integrated Europe has been to develop these. Now, not an easy task either. Hugo, if I can just come back to you on this. What are your latest thoughts on pan-European investment vehicles products? It's not seen much light of day either.
No, I mean, it's a proposal, a suggestion, which comes from different sources, from different angles, with different nuances, but in a nutshell, the idea is always the same, to try to create one vehicle or different vehicles of easy to buy, affordable, long-term, safe investment saving products to be offered mainly to retail investors in order to really make sure that the retail investor access the capital market. So, of course, this is an idea that we are going to look at together with all those who have proposed concrete measures in order to define what can be done. It's very important, the potential is very high. There's just one element that I would like to emphasize, is that if we do not address at the same time the big issue of taxation of those products, the big elephant in the room, probably we will have another PEP, which is certainly helpful, but has not dramatically changed the face of the retail investment products in Europe, although it was meant to do so.
Talking of PEPs, there's only one pan-European pension provider as of March this year. It was only available in 4 member states. So, James, if I can go over to you next. Governor Noye also highlighted this in his report, the importance of implementing long-term European savings products to increase those flows into European capital markets. So, James, what do you think of the Noye report proposal, given its success so far?
Well, I'm going to put myself behind that one as well. Look, if our goals are mobilizing resources, also enabling mobility of people within the union, then these products would be a useful thing. I think Hugo is absolutely right. Taxation will be a critical element of making products like this work. But there's a lot of other design features of the product. I mean, I think our experiment so far with the pan-European pension product is that its design features more than the concept caused it to struggle. And I think we can do a lot, whether it's sort of guarantees, fees, caps, marketability, the structures, if you like, or environments where we were, for example, very successful with creating UCITS in Europe. There are ways to make these vehicles work. Our proposal would be that we go with a label, in other words, set some minimum standards across Europe that qualify. I think it also would be something visible, if you like, to the voters and citizens of Europe. In other words, Capital Markets Union is something quite distant for most of the voters and citizens, whereas savings pension products, something with features that really speak to their household needs, can be something much more tangible.
Absolutely. I think most would agree with that. James, Stéphane, you'd like to add something?
Yeah, you are touching the most fundamental question of the coming years. How to make European equity great again. And fundamentally, anything we can say and discuss on the specific products is going to fix that magnitude of the problem, whereas the big issue there, how to bring back liquidity to the equity markets, how to bring back savings to own funds of European companies, depends on 3 other topics that have nothing to do with it. The first one is prudential ratios of institutional investors. A lot of effort has been done over the past, let's say, 15 years to reduce the risk of portfolios of large institutional investors. The macro problem we have today is not the macro problem we had 15 years ago. 15 years ago, the problem was there was a perception that there was too much risk in those portfolios, hence pressure on prudential ratios. Today, the macro risk is that there is not enough risk in the portfolios. If we want to finance long-term transitions in the digital world, in the climate world, in the defense world, we need to inject, or just growth of companies, of commercial companies, we need to put more risk in portfolios, not less risk in portfolios. And the solution here is a rapid, massive change on the prudential ratios. It's difficult because religion is a very inert concept, so removing a religious concept takes time, but that's the first thing. The second thing is pension. Everyone is flagelling themselves by, we have only 3% retail participation in equity markets in Europe and 30% retail participation in equity market in the US. Guess what? In the US, when you want to have some income when you get old or too tired or too lazy to work and you want to have some income, the only solution is to buy some equity when you are young, healthy, and working. In Europe, when you want to have some income when you are too old, too lazy, too tired to work, you just have to hope that the people around you at that time will continue to pay taxes and social contributions to pay for your income. That's the explanation of the difference between 3% retail participation in equity markets in Europe and 30% retail participation in equity market in the US. So unless you confront the need to migrate towards some form of higher capitalization, equitization of pension funds, you will never have a capital market union. And the third thing is what I've said earlier, the third blocker is the tax incentives. As long as it makes more sense to direct savings towards govies, then for sure, when you manage govies, when you do govies asset management, you go to the office, you buy a few OATs, and then at 9:30 you go to the spa. Now, if you want to manage an equity portfolio, it's much more hardworking. So the fundamental question is how we eliminate the tax bias that goes in favor of you have savings, buy govies instead of buy stocks, which makes much more sense on the long term in terms of yield and return, and how we create a situation where equity, European savings is metabolized into investments in European funds instead of having all the European savings, 300 billion per year, going to the US, invested in large US asset managers, coming back distributed through PEs, for example, and those PE guys coming back to take equity stakes in European companies. Maybe we can create some form of asset management or equity management of European savings to invest in European companies. So these are the three. Now, we can be precisely wrong rather than roughly correct with some bureaucratic fascination for this little product, why not? But the real solutions are prudential ratios, pension funds, and taxation of household savings.
Well, that's one big task at hand. Verena, in your recent paper of recommendations, you also focus on EU citizens and say how that cost-efficient investment options are crucial for empowering citizens to invest their savings in capital markets that serve their long-term needs. Now, key recommendations include the development of those basic long-term investment products, as discussed there, in pension systems, complemented by efforts to improve financial education. This is something we've talked about a lot. But Verena, how can this be done, and what should the next steps be?
Thank you for summarizing that so well, and I can only violently agree with what has already been said. I think this is certainly an area where we believe we need to continue to really help investors to get the access to some of the investments that will allow them to also participate in the benefits that capital markets can bring, and to diversify ultimately where they put their savings. Europe is still very bank-based as a continent. We know that investors with that are losing out sometimes on actually being able to participate in financial markets, and that means, as James said, we need to think about how can we create the right environment and the right incentives for investors to engage more in capital markets. And part of that could be, in our view, a label, simple, relatively low risk, although I agree with Stéphane, we also need to ensure that we actually ultimately shift the risk balance a bit and create more ability to take risks, to invest in innovative companies. But I think, as others have said, incentives play a crucial role. Tax incentives play a crucial role in that. So I fully agree with what people have said there. And then the second point I fully agree with is the pension system point. We need to make sure that we actually create more institutional capital in Europe through having better pension systems that actually allow for also funding to flow into European companies. So this is something which needs to be done, and obviously financial education has to be part of that as well. If we want our citizens to be more engaged in capital markets, we need to help them with support, education, and also the relevant advice where they need it. And as part of that, obviously, education is more of a long-term aim. We are not going overnight to completely change the ability of the normal citizen to engage in capital markets, but it has to be an important long-term goal, and certainly we, together with efforts already done by the Commission and by others, will need to continue to engage in that, also with the national authorities, to make sure that we push on that long-term aim.
Verena, thank you very much. Hugo.
Just to say that fully agree with what Verena just said, but to add a small element of I don't want to spoil the party, but I mean in terms, for example, of the difficulties that we have in the area of financial literacy, it has to be noticed that there's no particular legal basis in the European texts, in the treaty, etc., in order for us to act. So whatever we do is something that we do with the help of ESMA on a voluntary basis, you know, exchanging good practices, learning, explaining, and so on and so forth, but there's nothing we can do with the regulatory approach. The other difficulty, of course, that we have, I don't need to remind it, but when we talk about taxation, of course, the big issue is that the taxation requires unanimity in the system, and therefore, if the political will is difficult, you know, it doesn't help when we act in the sphere of qualified majority. I can only imagine what's the issue when we speak about unanimity.
Verena.
I think that's partly why it's so important that you actually now get the expressed political will to focus on capital market development again in the Council. Because I think in the end, a lot of the finance ministers have realized that they need to do something also at national level, whether that is on the taxation front, whether that's on the pension front or on other areas, that can only be done at national level with some encouragement, some kind of moving people in the same direction. But in the end, the important thing will be that it has to come from all sides. It can't just be a top-down approach. It has to come bottom-up as well.
Okay, that's great, Stéphane.
That's exactly the point. I mean, we are all very Europeans, and I do believe that more Europe fixes more problem than less Europe, for sure. But on that particular point of delivering more liquidity, more integration, a part of the solutions are in Brussels and Strasbourg, big time. But a part of the solutions are within the member states. And unless they unleash locally what needs to be done to reposition the taxation of the various saving products, to reorganize or re-architecture, redesign the pension funds and fix all the other issues I've mentioned, we will not have a proper integrated capital markets. The beauty, I think, to make European equity great again, mega, the beauty of this new ambition is that it seems that leadership is there. It seems that there is now the will to fix. And I'm confident, I'm optimistic. You know what? Because among the big successes of Europe over the past few years, most of them were delivered outside the treaties, outside the resignation of and the fatigue of all the ones who said, we tried, it's not possible. In a few weeks' time, the European bureaucracy was able to deliver the purchasing of 450 million doses of vaccines to vaccinate faster than in the rest of the planet, at a cheaper cost than in the rest of the planet, a much bigger population than anywhere in the rest of the planet for the COVID. We delivered eventually in July 20 the Next Generation EU program, the famous Hamiltonian moment that was not expected and was not provided anywhere in the treaties. We together here with our tax money pay 60 billion euro to support Ukraine in their fight against Russia at the same amount as the US do. So all that is not provided anywhere in the treaty, but we do it. So I'm confident that if there is a strong leadership, as it is clearly the case, but clearly it seems that there is an alignment between the German Chancellor, the French President, the Italian government, the Dutch government, the Spanish government to make it happen, it will happen. And the sooner, the better.
Thank you very much. James.
So I just wanted to add to what Stéphane said. I agree that to help foster an equity culture in Europe, the reforms of the pension system on a national level would make a whole lot of sense. And I agree, and especially certain countries where the reliance on the national system is greater, that is where the greater urgency is, because it's going to present a huge burden on the fiscal position of those countries over time. But I don't want to, by doing so, ignore the fixed income side of the equation. That there are, you know, if we're mobilizing a lot of resources for the digital transition, the green transition, a lot of that will be in the form of fixed income instruments as well, where the relief for the banking system would come from securitization, and where some of the solutions are a little bit less politically contentious, if you like, a little less visible to the average voter or taxpayer than is the case with big changes like the pension systems and what have you. And so I think one easy place to go in terms of capital markets unions reforms is supporting the securitization markets.
Okay, well, thank you very much. I'm afraid this is all we've got time for. I'm watching the clock, and the countdown is on to lunch now, and I'm sure you're all hungry. So thank you very much to our panelists, and thank you very much for joining us for this session.